Now let's take a high-level look at the new investment selection process for a VC. Every VC has their own process, and so this is certainly a generalization, but I think characterizes the overall approach that most investors take to the process. So it starts with a qualification meeting. So this is really just an introductory meeting that a low-level investor at a firm, an associate or a principal would take. Sometimes maybe a general partner for lower firms. But this is to get to know the entrepreneur, get to know the company, and then ultimately decide if this could ever be a qualified investment for that firm. What's important during the qualification meeting is to also qualify the investor for your startup and figure out, is this a good fit for what you're doing as well. The second phase is a phase that can take varying degrees of length. It could be very quick, something that happens in a week or two, or something that could happen over months or even years. It's basic nurturing and analysis. And so it's looking into the business, figuring out what are the risks, what are the strengths, what are the prospects for it moving forward, and then also taking a look at the entrepreneur and building a relationship with them and figuring out could we work together as a firm, as a company, and as individuals. If the firm qualifies you as a potential fit, does some analysis, gets to know you a little bit, and there's an opportunity to invest, they may move you into a due diligence phase. And this is really when they go through a formal process of researching your customers, researching your team, your employee contracts, really everything inside and out. And sometimes after doing some thorough due diligence, they'll put together a deal memo on your investment opportunity on your company and then present it at a partner meeting. And generally, firms need all of the partners to agree in order for an investment to happen. Some firms for certain investment sizes may only need one or two partners to make that investment happen. And then often after the partners agree, there may also be an investment committee that is maybe members of the LP community that firm has, or an expert that they have on in place that every investment needs to be approved by the investment committee. After the partners decide they want to invest, they'll issue a term sheet to the entrepreneur, which will overview the high-level terms for the deal. Not all of the terms and not all of the contract comes with the term sheet at this time, but really the important ones like valuation, amount that's being invested, the vehicle will be included. And then there may be a small due diligence phase, and assuming the entrepreneur wants to accept the term sheet, they will sign the term sheet, finish any due diligence items, review the final investment documents, which will be considerably longer, especially for an equity round, and then they will sign the final documents, wire the money, and then the deal will be done. A quick note on Capital Factory's investment criteria. I mentioned earlier that we've been the most active VC in Texas for about 5 years now. That doesn't mean we write the largest checks or invest the most. That means we write the most checks. We make 1 or 2 investments per week on average. And the way we're able to do that is we follow on other institutional VC investors. So a traditional VC will go through the investment process I just described and do their own due diligence, set the terms of the deal, and often they'll leave anywhere from 25 to 50% of the round open for co-investors, other VCs to come follow on at the same terms. And so that's how Capital Factory invests. We actually get rights to invest in a lot of companies through our accelerator program, through previous funds, and then we also just get invited into rounds. And so we'll invest $50,000 to $250,000 into funding rounds over $1 million. And generally, the really core thing we look for in that is we want to invest in entrepreneurs we know and that we can help. And so we get to know entrepreneurs through programs, events, our accelerator, introducing them to our investor network, our corporate partner network. And through that process, we get feedback from all of our mentors, the investors, the corporate decision makers, and that really builds our profile as an investor. And then the traditional investor comes in, leads the round, and we'll invest on top of that. And so getting to know entrepreneurs through programming, our accelerator content, and items like that makes it really easy for us to invest very fast when larger investors come in. And so that's how Capital Factory invests.